Add up every subscription you're paying for. Streaming, music, the cloud storage you forgot about. It's probably north of $25 a week. Right now, all of it flows in one direction. Out of you, into them. So what happens if you point that same $25 the other way? In this video, Josh takes that same $25, the streaming money, that cloud storage you forgot you were paying for, and sends it to 5 Vanguard Index Funds. I'll show you what an index fund actually is, which 5 Vanguard funds Josh selected, and in the end, I will show you how this Vanguard Index Fund portfolio is projected to turn $25 a week into a $500,000 portfolio that pays over $6,000 a month in dividend income. $6,000 a month? Sounds like a lot, right? But that number doesn't tell you much on its own. You need something to hold it against. Start with a full-time paycheck. That's really what $6,000 a month is up against. The median American working full-time earns about $1,233 a week, about $5,343 a month. That's the middle of the whole country. Half of everyone learns less than that. So put $6,000 right next to it. That's a full salary, the kind of money you set an alarm for, sit in traffic for, answer to a boss for. The version we are building asks for none of that. And that's the whole reason $6,000 is the target. This was never about getting rich. It's the line where the money you don't work for finally out-earns the money you do. There's just one problem. $25 a week doesn't buy companies. It buys a list. That's all an index really is. A list. The S&P 500 is just a list of 500 big American companies. Nobody writes it down, it updates on a schedule. And that's the whole invention. An index fund buys the list. All of it. In order. It doesn't think about it. And that's the whole trick. 3 things. It owns everything on the list, so no single disaster sinks you. It picks nothing, because there's nobody sitting there guessing which company wins. And it costs almost nothing to run. The last one matters more than it sounds. A fund's fee is called the expense ratio, and it comes out of your money automatically every year. You never see a bill. Real index funds charge somewhere between 0.03% and 0.09%. On $1,000, that's about 50 cents a year. Owns everything, picks nothing, costs nothing. That's the rule. Hold on to it, because one of these 5 funds breaks it on purpose. And that's the one doing the heaviest lifting in the entire portfolio. How does Josh pick 5 funds out of thousands? 3 filters. That's it. He goes for dividend growth over high yield, because growth is the thing that actually compounds. He wants 5 completely different engines, so no 2 do the same job. And he keeps the overlap low. Josh starts with Vanguard International Dividend Appreciation. This one was built for exactly what this video is about. The name is the strategy. It goes looking for companies with a long record of raising what they pay out, and it buys those. 380 of them spread across the developed world. Royal Bank of Canada is the largest position at 4.52%. Then Mitsubishi UFJ, Nestle, Novartis, Roche, SAP, Novo Nordisk. These are companies that run the rest of the world. And it spreads wide. 11 sectors with the biggest one, financials, taking 28% of it. The 10 largest positions together come to 34.35%. Nothing here is carrying the fund on its own. That balance shows up in the risk numbers, called standard deviation. Standard deviation is just how far a price swings around its own average. Bigger number, wider range. VIAAX sits at 13.72 against 16.70 for the average fund in its category. It moves less than its own peers. Beta of 0.85, Morningstar puts its risk in the low band. It also behaves the way an index fund should. Just 14% turnover, which is a fancy way of saying it buys the list and then mostly leaves it alone. So what does all this steadiness pay? A 2.02% yield, dividend growth of 12.61%, and an average share price appreciation of 5.37%. Josh starts here on purpose. This is the floor, everything else gets to stand on. The next fund on Josh's list is Vanguard Communication Services Index Fund. This fund holds 116 names. Meta is 20.31% of it. Alphabet shows up twice because it has two share classes, and those two lines come up to another 22.19% between them. So 42.5% of the fund is two businesses, and the other 114 are splitting what's left. That's the whole design. Communication services is one of the 11 slices the market gets cut into: phones, streaming, search, social. The stuff you touch all day without thinking about it. Disney's in there, Netflix, Verizon, AT&T, Comcast. And 98.92% of the fund is committed to that one slice. Now, here's why it sits in a dividend portfolio. Google went public in 2004. It didn't pay a dividend until 2024. Facebook went public in 2012. Meta didn't pay one until 2024 either. Then, that year, it all changed at once. Meta declared its first dividend in February. Alphabet followed about 12 weeks later. And this fund already owned both of them, 42.5% of it. The day those checks switched on, it caught the two biggest brand new dividends in the market at the exact moment they started, which is why the numbers read the way they do. VTCAX runs a 1.01% yield, dividend growth of 16.94% over the last 5 years, and share price appreciation around 6.76%. And that 16.94% is the second fastest growing dividend in this portfolio. It cost 0.09%, tied for the cheapest on the list. Turnover is 12%, so it buys the list and holds it. And Morningstar tags it low carbon, a carbon risk score of 3.35. With a risk score of 79, Morningstar tags it as very aggressive. Josh wants that 16.94%. This is where it comes from. So that's 2 down. Next is Vanguard US Multi-Factor Fund. This one gets 5 stars from Morningstar, the only fund on this whole list that earns them, and it's the exact opposite of what you just watched. VTCAX crammed 42.5% into 2 companies. This fund holds 581, and its 10 biggest positions add up to 8.56% of it. Combined, the single largest thing in here is smaller than VIAAX's 10th largest holding. That's how spread out it is. Now, remember the rule: an index fund buys a list somebody else already wrote. This one writes its own. That's what multi-factor means. It runs every company in America through a screen looking for 3 things at once: a low price next to what the business is actually worth, a healthy balance sheet, and a share price already moving the right way. Whatever clears all 3 makes the list. And then it buys the whole list, exactly like any other index fund. There's no human in a back room with a hunch about Apple. It's a model. It runs on rules, and it's cheap for that exact reason. 0.18% a year, about $18 a year on a $10,000 investment. And look at who the rules let in: Newmont, the gold miner, Bank of New York Mellon, Gilead, McKesson, Walmart. Boring American businesses, nearly 17% of the fund sitting in healthcare, and none of it riding on any one name. That's the whole reason it made the cut. VTCAX was about phones and search. This is the only fund on the list holding the unglamorous stuff nobody makes videos about. It pays a 1.45% dividend yield, a dividend growth rate of 15.28% over 5 years, and an average appreciation of 9.77%, the highest appreciation of anything in this account. Now, Vanguard's own SEC filing puts it at 9.82% a year since it launched in 2018, against 13.07% for the Russell 3000. That gap is the fund doing precisely what it was built to do. This was the decade in which a handful of enormous tech names carried the entire index. A fund screening for cheap, healthy, unglamorous businesses was always going to be holding something else. Josh already owns a fund that's half Meta and Alphabet. What he wants is the other half of America. Okay, 3 down, 2 to go. And in the end, I'll show you how a portfolio of these funds is projected to turn $25 a week into a $500,000 portfolio that pays over $6,000 a month in dividend income. First, let's meet the last two. Fourth on the list is Vanguard Energy Index Fund. This one is a job none of the others can do. Vanguard Energy is basically 98% oil and gas. Exxon alone is 21.52% of it. Chevron, another 13.43%. Then Conoco, Williams, and Valero. These companies put the stuff out of the ground and move it around the planet. And it's the only fund on this list that answers to something other than the stock market. Think about what actually drives oil. Barrels. How many are coming out of the ground and how many the world wants. That doesn't have a lot to do with whether tech had a good chapter. There's a number that measures this. And it's the whole reason the fund is in here. It's called R². And it tells you how much of a fund's movement is really just the market moving underneath it. VIAAX sits at 86.54, VMMSX at 81, VTCAX at 74. So all three of those mostly do whatever the market does. It rises, they rise. It drops, they're right there with it. Vanguard Energy is 30.24, roughly 70% of what this fund does, it does on its own. It's the only thing in this account that walks by itself. It's also the closest thing here to a plain index fund. 11% turnover, lowest of the five by a mile. It buys the energy list and then just sits on it. And it's tied for the cheapest at 0.09% a year. Here's where the numbers land. A 2.53% yield, the highest in the portfolio, with dividend growth of 9.99% and appreciation averaging 5.16%. Now, here's how it stacks up against every other energy fund out there. Morningstar rates its returns above its category. So among the energy options, this is a strong one. One honest note, this is oil. It's the single fund here that won't sit right if clean energy is part of how you pick. Worth knowing going in. And the last fund on Josh's list is the Vanguard Emerging Markets. This one is 7 people picking the stocks. Vanguard Emerging Markets Select Stock holds 286 companies across the developing world. Taiwan Semiconductor alone is 11.56% of it, with names like Tencent, Alibaba, Samsung, and SK Hynix filling in behind it. Almost a quarter of the fund is technology. Another fifth is banks. Emerging markets just means economies that are still climbing. Taiwan, China, Korea, Brazil, India. Younger, faster, and growing from a much smaller base than ours. Now here's how Vanguard actually runs this one. Straight out of their own SEC filing. One line. The fund employs an active management approach. Then they name the people. 3 outside firms, Bailey Gifford, Pazina, and Wellington Management, with 7 portfolio managers between them, each one independently picking stocks for their own slice. 2 of them, Caroline Tsai and Allison Fish, have run it since the fund opened in 2011, 15 years on the same money. This fund selects, it pays people too, and it charges for it. That's the one that deviates a little from the rules, but it makes up for that in dividend growth. $10,000 in this fund means a management fee of $84. Here's what that buys. Same filing, their own table. Over 10 years, the FTSE Emerging Index returned 8.60% a year. This fund returned 9.31%. Over 5 years, ahead again. And last year, the index did 26.06%. The fund did 35.66%. 3 for 3, after fees, against the exact list it measured against. And they're patient with it. 33% turnover, 7 managers free to trade anything they want, and 2/3 of the portfolio just sits untouched. Put all that human work into one place, and it comes out as 2.01% yield. Dividend growth running 18.74% a year, and appreciation of 6.40%. Josh lines all 5 up and sees the one thing they share. Every one of them is a specialist. Stack all 5 at equal weight, 20% each, and the whole portfolio lands on a 1.80% yield, 14.71% dividend growth, and 6.69% appreciation. Now let's find out what $25 a week looks like in this portfolio. So Josh puts $25 a week into this portfolio. By the end of year 1, he's invested $1,300. That's his $25 a week, 52 weeks in a row. By year 10, he's contributed $13,000. The balance is projected at $20,353, and the income reaches $624 for the year. That's $52 a month. By year 20, 2/3 of the money is in $26,000. The balance is projected at $89,138, and the income lands at $5,993, $499 a month. By year 30, the balance is projected at $537,480, and the income $73,313 for the year, $6,109 a month. But not everyone has 30 years to give it. So here's the other way to do this. One fund, SCHD, and one lump sum sending in it today. How much do you need to reach that retirement income target in 20 or 10 years? That video's on screen.